Hey everybody, it's Coach Holmes here. Welcome to the YouTube live special for November 4th. It's going to be the election issue, the election edition, I guess, if you want to call it. Obviously, kind of a big deal yesterday, still ongoing today. Let's see if we can see you guys out in YouTube land there. Let me see if I can get to see your comments there. Just bear with me one second. I really can't see that just yet. One second. Should be popping up any second. Hopefully I'll see you guys shortly here. So anyway, while I wait for that, we'll get going here. So like I said, we're just going to talk about, the election and things that went on with it. I see a chat here. Just one second. Okay, maybe I need to be on that. Let's just see if I can do this properly. Bear with me, kids. Never mind. I'm in there, but I can't see it. Just one second here. It's not sharing yet, so one second, everybody, bear with me. Little technical difficulties here, and we'll get started. So as I was saying, we're going to look at the markets and see what the basically what the effect has been since the election finished up. Well, I guess the actual voting part of it finished up yesterday, but there were some interesting things going on before the market or in the market before the election, and even more so today as well. So we're going to look at that as well. And then we're going to talk about basically the big thing is the portfolio. You know, what did you guys do with your portfolio? Did you just let it sit? Did you make some changes? Just those kinds of things. That's really what I want to look at today. We're going to talk about some ideas that can give us, just give us kind of a little bit of an easier feeling when it comes to dealing with these kinds of events, because there's lots more events like this. We've had Brexit. We've got this election, even the last election as well. These events are going to continue to come up, and so it's a good thing to make sure that you're aware of these things and that you take the necessary steps to protect yourself. So, like I said, there's a few different interesting kind of concepts that I want to talk about, and so now I can see. All right, I got chat. Okay, this is good. Yeah, okay, good. I see. Hey, Coach Greg, that's awesome. All right, you guys are here. Sweet. All right. Now I can continue on. All right. I'm going to share my screen here. Like I said, I want to look at a few things. We'll look at the markets before before the election, because I think there's some things to talk about there. If I can get my Thinkorswim up here. There we go. If you guys can let me know if you can see my Thinkorswim, that'd be awesome. Let me get rid of that. Let's pull up this here. Let's look at the futures. I think that's the best place to start. So Ahmad says closed all trades. That's good. Waiting for uncertainty. Very good. All right. Yeah, I can see your chats. That's awesome. Okay. And I can see the Thinkorswim now. So a couple of different things I thought, maybe you guys can kind of chime in a little bit and let me know what you thought. But I kind of felt that the market was pricing in some of the uncertainty, some of the stuff that was going on pre-election, that we had the better part of 2.5 weeks there where the market was pulling back. And, I thought, with all this downside, could there have been more downside? Absolutely. And that's really what this YouTube live webinar is going to be all about tonight is how do you protect against this kind of stuff? Obviously when we start to see these moves, we can make adjustments ourselves and kind of protect this. But when we have an event that we know is coming up, it could be earnings, it could be, a big event like the election, it could be Brexit. We knew Brexit was coming too, and it created a lot of scenarios scenarios. But you know, the few of the things that you could do is what we're going to talk about today. And I think it's so important because really what happened after the event, which is today, right? And I understand they're still counting ballots and all that stuff, and they haven't declared a winner, so to speak. But the movement today was very, very interesting, and I think it's something that we can look at and just, you know, from a sector perspective today as well. Sector and an index perspective was very interesting as well. So, like I said, kind of saw a little bit of this stuff maybe priced in, a little bit of this downside. Now there was lots of other reasons for that. You know, margin requirements changed, so some of this fall that we saw here, you know, with the brokers, they were amping up the margin for the last at least I think for 2 weeks or so, I got emails from the broker saying that they were changing the margin requirements. That was for day trading, but as well as other margins as well. So anyway, you know, some of this might have been priced in that way, and the market has a really good way of pricing in, you know, events that are coming. Like it just seems to know. It seems to know before we know, and so the reality is we still need to protect ourselves from, you know, things that can't be known. Okay, so really, I don't think anybody, you know, with any degree of certainty could have said that, you know, the election was going to be as close as it was. You know, if you looked at the polls, it seemed that you know, Joe Biden had a pretty big lead going into this. You know, a lot of you know, media that way. So I don't think we really could have predicted that it would have been as close as it was. I'm sure some folks said that, but I don't know that we would have done it with any certainty. So not knowing that, you know, we're kind of letting ourselves sit there in peril. You know what I mean? Like if we just said, okay, well, you know what, my portfolio is what it is, you know, let's just let it ride, so to speak. That's one way to do it, but in my experience, in my you know, trading knowledge, that's never really worked out that well, and I think we can be better at that. You know what I mean? So anyway, I want to, like I said, talk a little bit about what's happened today. I don't know if you guys are watching the markets today. I'm just going to kind of go through some of the sections. I'll go through the indices first. So pretty big candle today. You'll notice that the big wicks on both the top and bottom. So we had a wide range today, but look at the size of this candle in relation to the other two. So today was a big day. Now, the one thing that was probably no surprise to anybody was the VIX, the volatility index. Okay, so you can see here, if you look at this candle here, the VIX just got hammered down today, which, you know, totally expected. We were seeing an increase in volatility because of the uncertainty. Now some of that uncertainty has gone away. However, this candle is very big, so it was a real pullback, and so that could be the market pricing things in as well. So, like I said, that was the one thing that wasn't a surprise. A couple of things that were surprises, at least in my estimation. You know, the Dow here. Again, pretty big pop on the day, but settled out kind of, you know, in the middle there. But if you start looking at the individual pieces of the Dow, you know, some of the individual pieces of the Dow, some of the sectors, things like that, the sectors didn't fare near as well as the index there. And we'll take a real quick look at that as well. So tech seemed to have some strength today. You know, like you can see the real difference in the chart here. Look at the size of this candle for tech. Now, if you'd been watching tech for the last few weeks, you'd have seen that this thing was getting beat up pretty bad. You know, like this was, you know, darn near nice, you know, 45-degree angle and down to the bottom there. So real big, strong candle today, showing some strength there. When we get to some of the individual sectors, you're going to see that even though this thrust forward, there was a pretty sizable pullback to resistance levels, and we'll see that when we get to the individual sectors. So, like I said, tech was decent today. Industrials not so much. You know, the S&P 500, big pop, but again, like I said, the sellers came in late in the day. If you happen to be watching this on a shorter time frame, there, you know, you can see here, like I said, right at the end of the day, there, it kind of crested. and started to pull back a little bit, kind of leveled out. You can see that I've got the Bollinger Bands installed here, on the 15-minute chart, kind of got up, touched that Bollinger Band, pushed back down, and kind of leveled right down at the low there. For those who don't know, Bollinger Bands, basically we're looking at overbought, oversold conditions there. So really, that's kind of what we were seeing here. A little bounce once we got down to that lower Bollinger Band. But you can see what happened with the volatility. Okay, so even on a 15-minute chart here, the volatility was very, very wide, and then it narrowed down, and it's still narrowing down a little bit further. So, like I said, just kind of an interesting day. And then the Russell 2000, if I can type it in. RTY, there we go. So this one here, let's get out to a bigger chart. So you can see here, this one I found to be the most interesting today. Big red candle, meaning it closed lower than it opened. Okay, big tails on both sides, doji kind of thing here. Looks like it's kind of caught a level of resistance here that it tried to break above and kind of got smacked down again. Very interesting for the small cap stocks. Okay, so again, we're maybe getting back into that time where, a few months back there, tech was just charging, just leading the way, charging through everything, and we had the Dow and the Russell were lagging a little bit. So perhaps that part's coming back again. We'll have to wait and see. But I just thought that was very interesting, the contrast in the markets and the contrast in the different types of equities that we were looking at. So quickly, we'll look through the sectors here. Home builders, I thought was crazy today. If you guys were watching that, look, a couple of gaps here the last 2 days before the election, and then today. Big, like double the size of the candle over basically the last two there. But again, the sellers came in late in the day there, which I think is very telling. So tomorrow will be a very interesting day. We've got a few of the others here. You're going to see a lot of this here. A lot of these red dojis, okay? This is indecision. So, as much as there's indecision about the market, there's indecision when it comes to, these sectors as well. Basic materials, red day today. Communications, look at where communications ended. This one I found to be very interesting. So typically, when you get the tech sector rising, the communications sector kind of going with it. But look where this one ended up here. It ran right up pretty hard, pulled right back, and basically made a triple top here. Top here, top over there for the body, triple top there. Interesting spot there, okay? If it closed above there, then I would have said we're kind of off to the races with the XLC here, but I'd be a little bit cautious there. You're right at the upper end of the Bollinger Band there, and like I said, kind of building in a triple top there. So found that to be very interesting today as well. Energy, basically unchanged on the day. That's what this white one means. It's a doji, basically opened and closed pretty much the same. Opened at 29.57 and closed at 29.57. You don't see that too often. So a lot of indecision with the energy sector. Financials, green day, but really didn't do anything to speak of. This one I thought was very interesting. So like I said, industrials. We looked at the Dow, and it didn't show the same thing here. If I go back to the Dow real quick here, the YM. Okay, we had a green candle today in the futures. Okay, so green candle meaning it closed higher than it opened. But then we go look at the industrial sector, and what do we get here? We get a red candle, red doji, with big long tails on it. So very interesting contrast in those two things, right? So one's the industrial futures, which is showing a little bit of strength, and then one's the industrial sector that didn't show the same thing. So these contrasts are very interesting, and a few of the reasons why the obvious reasons are uncertainty, right? But one of the other reasons that this is happening is a lack of liquidity, okay? A lack of participation in the markets. The uncertainty is driving this, but we've got a lot of free air in the markets right now where we're not getting a ton of participation. And when you get that lack of liquidity, that's when you get these really big ranges and these really big swings. And this is also something that when you're looking at your portfolio, this is what you got to take into consideration. You need to understand, okay, what are the conditions that I'm living under? And as Ahmed said there, or Ahmed, I don't know if I said it right, but hopefully I did. He said he closed out all his positions and waited for the uncertainty to go away. Not a bad idea, right? Because when you have this kind of trade, I don't know if you guys were watching the futures last night, but the futures were crazy. Like, I've traded futures before a lot. I day trade futures, but to see them move as fast as they were last night, I'd never seen the numbers moving that fast. Even in the last election, they didn't seem to be moving as fast as they were last night. So very, very interesting times for trading the futures if you happen to be doing that as well. So like I said, technology was strong, kind of right smack dab in the middle of these Bollinger Bands. Looks like it's got some room to run as long as nothing's holding it back. Upside down hammer candle here. So showed a little bit of strength early in the day, and they got kind of beat up at the end of the day for XLP here. The real estate, this I find somewhat interesting as well. Big red doji here, yet the home builders, as we looked at the start, had a very, very strong day. So real estate, not so much, and home builders a little bit. I know they're not too super correlated, but it is kind of interesting to see how they worked out. Utilities been doing real well, and look where it ended again. So another double top there, right? Boom, right there. If I can actually get it to draw. Another double top right there before getting smacked down late in the day. Very interesting there as well. Now this one, XLV, just flying high. Look at this thing. Now, again, got outside his Bollinger Band and pulled back, but look at the gap here that this put in tonight. Healthcare, just blasted up. Very interesting, show a lot of strength there. Okay. XLY, kind of mediocre, and I won't go through the rest of these too much. Oil didn't, virtually nothing. There's a few others here, but I thought that was very interesting, the contrast in the sectors being a little bit strange, really. Kind of feeling, I guess, the uncertainty of the markets and feeling the uncertainty of the election. It really showed that in the charts today. So, what do we do? What do we need to do to our portfolios before these kinds of events, or even before earnings? We've had a couple of folks in here. Okay, we collared the trades and closed some positions. Ahmed said he closed a bunch of them. Or closed all of them. Nothing wrong with those strategies. There's other ways to tackle it, and we're going to talk a little bit about that. But those are good things. If you don't have the skill set and the knowledge to kind of trade through this, then this can be very interesting. So, Ahmed said, what brokers do you use to trade futures in Canada? I use Interactive Brokers. It's not my favorite, but it is one of the ones that I use. Like I said, I don't want to give them a ringing endorsement because I think there are better brokers out there, but that's the one I use. Hey, nice to see you. So, like I said, let's kind of get into the meat of the presentation tonight. So I call this portfolio event preparation. All right, and there's three things that, as far as I'm concerned, that you really need to do and do it well if you're going to save your portfolio. So let me get this. So first of all is we got to reduce risk. Okay, when you start thinking about let's say you've got a pain threshold that you begin with. Okay. In a normal pain threshold, let's say you're willing to risk $300 on any one trade. Okay. When volatility and uncertainty are not there, $300 might be okay. Okay. You might have a stop loss. Let's just say you've just bought a stock and you've got a stop loss there, and you say, okay, I'm going to get out if it hits this level. Okay. That's all fine and dandy when things are, I don't want to say normal because I don't know that there is a normal time, but when things are less volatile, that might be okay. But the likelihood of gapping when we get this increased volatility is quite a bit bigger. So when it comes to that, we need to do things to reduce risk. And a couple of you guys have already said it. Close your positions early. There's nothing wrong with this. Okay, even if you take a small loss or a small gain, it's better to be out of the market. One of my mentors used to say it this way, I'd rather be on the ground watching the plane fly away than being in the plane and wishing I was on the ground. Okay, and that's really what it comes down to when there's approximately 220 trading days in a year. There's ample opportunity for us to make money in the markets. We don't need to put ourselves in a position where it's going to be detrimental to us. We just don't have to, we don't need to put ourselves there. There's just too much. There's too many opportunities there where, as retail traders, our biggest edge as retail traders is the fact that we don't have to participate. We can sit on the sidelines, sit in cash, and just wait for our shots. So Ahmed says TOS doesn't offer futures. Yeah, it doesn't offer futures for Canadians. Unfortunately, it does for everybody else except us, Ahmed. And I've had many conversations with Thinkorswim, and they it says Neil just got approved to trade futures today. Okay, well maybe they've changed, and I hope you're right. There are I don't know, YTQ Fung Mail. Are you Canadian by chance? Let him or her see if they type in there. Anyway, I was going to say that'd be great if they would give that to us as Canadians, but I'm not holding my breath because, like I said, many conversations with TOS and never got anywhere with it. So anyway, so like I said, closing positions early is a good step. Let me see if I can do this better. Actually, make these points a little bit better. I'll go this way. Sorry. All right, so you close positions early. What I like to do, and I don't know how many of you guys do this, but if you're trading credit spreads, you can close one leg of the spread, okay? One leg of the spread. This is a very, very smart idea when you get some crazy stuff going on. So sorry, you're in the USA. Yeah, that's okay. So closing one leg of the spread, get rid of the short leg, okay? Especially if you've got some profit locked up, because then you got yourself a lottery ticket, okay? If you got a credit spread, you know what I mean, and you've got the short and long leg, and you end up closing the short leg, and then all of a sudden things get very, very volatile. All of a sudden you've got yourself a lottery ticket. If it goes the other way, which if you guys were watching the futures last night, we had a very large swing up and a very large swing down, and that's where you closing one of the legs. Not only do you get rid of the risk, the assignment risk, right, but you also put yourself in a position to profit from that other leg. So closing the short leg is not always a bad idea either, and letting the long leg run. Okay, long leg run. So not a bad idea for there. Again, these are just some ideas that you can use to again, we're just thinking about, okay, how much risk do I have? I've got a paper trading account here. We're going to actually look at some of the things that I mentioned over the next little while to see how this is actually done. And I know some of you have already done some of these things, but I think it's important for everybody to see this. So you close one leg of the spread. You know what? One of the things that I do, again, if you're doing credit spreads or, anything really, is closing half the position, okay? So if you've got 6 contracts on, okay, and that's your normal risk tolerance, okay? If you close it down to three, you've still got an opportunity to make some money, but you're not going to take all that risk. So instead of having that $300, $400, $500 loss, maybe you got $150, $200. Okay, you can sit there and you can save yourself a lot of heartache. And the thing is the only thing that we can truly control when it comes to the markets is when we get in and when we get out. Okay, that's really what we're doing here. So this way we can control. We can't control whether it's going to go up or down according to the results of the election. We can't control whether volatility is going to increase or decrease. We can have an idea of that. We can look at the VIX. We can look at implied volatility. We can do those things. We can enter trades according to that, but we really can't control that. But what we control is our participation. So Alma says, isn't closing a leg make you give away from cash? Isn't closing a leg makes you give away some from get. Yeah, so depending on where you're at, basically from a theta standpoint, it can cost you some money to close that. But what I'm saying is, Ahmed, if you close the short leg, maybe it costs you a couple of bucks. If it goes in the opposite direction, you can more than make up, because then you now have either in the case of a bull put, you'd have a long put or a long call in the case of a bear call. And if the stock moves as far as we think it does in a volatile environment, then it can more than offset any downside. And again, you have to have some conviction in whether you think the markets are going to move or not. If it's a slow moving stock, then obviously that's not the right strategy to go with. But if it's something that has the ability to move, like I said, if you'd have been watching the futures last night at anywhere from 10 to midnight, those things were moving very, very quickly, and there was a lot of ground cover just from the ups and downs of it. So, obviously your stock's maybe not doing that during that time, but if you're watching the futures contracts, you can see that stuff moving, and that's where you can see the gaps happening in the next day. So, anyway, something to think about for that. So, like I said, close half of all positions, and again, all we're doing there is reducing the risk. Okay. And then finally, to reduce risk, we want to tighten the stops. Okay. This is probably goes without saying, but tightening stops is not a bad idea either. Now, the reality is when you tighten stops, you might get whipsawed out. Okay. I would rather get whipsawed out of a trade, okay, than to lose more than I should because I've widened out my stop too much. Okay. Now, obviously, you don't want to leave it. You don't want to tighten it up so much that you're guaranteed to get whipsawed. But what I'm saying is, I don't necessarily want to double up the width of my stop just because it's gotten volatile and increase my risk. That's what I'm saying. You want to keep that. We're trying to keep the risk low here, not increase it. Okay. So anyway, some to think about there. So that's reducing risk. Okay. So the next thing that you got to look at, or that I think is good to look at, is delta hedging. So I'll get you guys to type in, how many of you have done delta hedging or seen delta hedging before? Let's see if we get some answers in there for that. While I'm waiting for that, I keep forgetting there's a bit of a lag here. So anyway, delta hedging, it's one of the great art forms of trading as far as I'm concerned, and it's so freeing from a stress perspective. If you can get your portfolio to a point where it doesn't stress you out, you're calm, and you're in tune with your own portfolio, it can make so much make trading so much nicer, you know what I mean, than having to sit in there and worry about every tick. So Try does a little bit. One male always wanted to know. Good. So got a couple of answers there for the delta hedging. So for delta hedging, all we're doing is we're trying to make our portfolio, okay, our portfolio delta, I'll get typing one day. We'll make our portfolio delta as close to neutral as possible. Okay, so if you think about it, as possible. Okay, if you think about it, for those who fully understand delta, I'm going to give the Coles Notes version of it here. If you've got a positive delta of 50, let's say, okay, and the stock or the index or the ETF that you trade goes up $1, that if it goes up and you've got let's say a long call and you got a 50 call, an at the money call, it's going to go up 50 cents. Okay, so that's your positive delta. Now, if you got a negative delta, obviously it's going to go the other way. You're going to lose 50 cents there per dollar move. Okay, so that's pretty easy to understand. But when you get a whole bunch of positions, maybe you've got 10 or 15 positions and you got this big delta at the bottom, all of a sudden a $1 move in the index or whatever you're basing it against, all of a sudden that can translate to very big money. So what we're trying to do is take that delta and we're getting it as close to zero as we possibly can. So Callan says done it in TOS but not IB, and Gino says had never done this. Okay. So I'm going to show you guys a little bit. I've got a mock portfolio here. I'm going to kind of show you some of the things that I did to offset some delta here, and you guys can see how that works. But all we're trying to do is get it to neutral, because if you had a delta of 0.04, okay, and the S&P 500 goes up by $1, your portfolio go up by 4 cents, okay? If it goes down, you go down by 4 cents. Well, that's not going to hurt anybody. Nobody's even going to blink at that. You wouldn't even know that. And it is possible to get your delta really, really close to zero. So, you know, you don't have to close everything out necessarily if you learn to delta hedge, or you put on some opposing type trades to get your delta down to there. All of a sudden, you can sit back and you can feel good about yourself in the fact that, hey, if it goes to one way or the other too far, I'm not going to lose that much money, okay? And so it's a really good way to be able to sit there, still be involved in the market. Maybe you've got a great theta sitting there working for you. That's really ideally what you want. But if you've got a very close to zero delta and a positive theta number, then you're just sitting back collecting the cash, and then that's really the best place to be. And I'll show you guys a little bit of that soon. So, like I said, trying to get that portfolio hedge as close to delta, getting the delta as close to neutral as possible. The other thing is for core positions, okay? For those who, and I know a couple of you guys put those in there, for core positions, there's nothing wrong with collaring core positions, okay? So to collar a core position, now what I say by a core position, so maybe you've got some cash flow going on, you've got some cover call trades, you bought the stock and you've got some cover calls. Throwing a put to neutralize that trade, to kind of lock it down, collar that trade is a good idea as well. What that will do is not only will it reduce the risk of that particular trade, but it will offset your total portfolio delta too, and I'll show you guys that as well. So collar the trades, like I said, that's one of the ways that we can get that delta hedge. One of the ways that we can get the delta down to a manageable number, and that's really what we're trying to do here when we're protecting our portfolio. So that's a little bit about delta hedging. That's a couple of different ways. Now, when we talk about delta hedging, we can do it in a lot of different ways, okay? We can use option positions, okay? We can buy puts, okay? We could buy put spreads, okay? We could do put spreads, these would be put debit spreads, right? You're not going to probably do that with, well, you could do bear call spreads, but you're probably putting yourself a little bit of peril there. So you could buy put debit spreads, okay? We can use that with futures contracts, okay? Well, micros and minis, okay? Micros and mini future contracts. These are really great for offsetting some risk. And what it does, one of the things that I like about the futures more than anything else is that it takes the volatility out of things, okay? When we're dealing with options, we always got to deal with the volatility, the increases and the swings of volatility. With futures contracts, we don't need to worry about that. It's a straight pricing model, and all we got to do is make sure that we've got an offsetting delta, and we can again delta hedge with that, get it to neutral, and make it safe. Okay, so we'll look a little bit at those as well. So finally, the third thing that I think that we really got to do is we got to think about time. Okay, so again, I don't know, how many of you were trading last night, or even the night before that. I don't tend to trade futures overnight too much. I usually day trade them, but last night there was so much going on that we finally got some decent movement after hours, and it was actually a good time to trade if you understand that. But before you could do that, you have to start thinking about time frames. You have to start thinking about, we're not swing trading anymore. We're not position trading anymore. When these kind of volatile events came out, you've got to narrow your focus really, really, tight, because you're going to have these fast moving markets, right? So you got to narrow that focus to match the market that you have. Okay. So if you're, like I said, if you happen to be trading the futures last night, you could be in and out of a trade, like in minutes. Okay. Like it's literally, obviously if you're looking at longer time frames, maybe you're looking at a 30 or 15 minute chart, you might be in a trade a little bit longer. If you're in a 5 and a 1 minute chart, all of a sudden you're going to need to narrow your focus, and your trade's going to be becoming fast and furious, right? This is what happens also in a bear market. For those who haven't been through them, in a bear market, you're going to reach your destination, whether it's, let's say you do a stock trade and you put on a stop loss and a target. In a bear market, you're going to hit those targets or stop losses much faster than you would in a bull market, because everything's moving, so much faster that you really got to, like I said, that narrowed focus is very important. So match the market that you're trading in. Okay. So then the last thing is you got to be nimble. Okay. When it comes to these kind of events as well, you got to be nimble in the fact that you might need to switch to the other side of a trade. Okay. And again, I use the example last night of trading futures. Okay. Last night, I think I went from probably bullish to bearish, I don't know, 6 or 7 times last night. 6 or 7 times I got information that made me want to change my bias. Okay. Basically was looking at a bullish setup, and then the next thing you know, I was looking at a bearish setup. You have to be nimble, and you have to be willing to change position if necessary. Okay. Now, this isn't going to happen with your long-term portfolio so much, but it's definitely something. If you do happen to trade, if you do trade around these events, and this is more for the folks that are a little bit more experienced, if you're going to trade around these events, you got to make sure that you're nimble and that you're ready to flip if you need to. Okay. So if required. And finally, the last thing that I'll say is, especially this is more for your portfolio. If you've tightened up your stop and you've closed your positions, or you've closed half your positions, or you've broken legs, or whatever you've done to your portfolio to kind of protect it, the last thing you need to do, and you need to be certain to do this, is to incorporate into your daily routine where you're checking out your portfolio a little more often than maybe you normally would. Okay. So if let's say maybe you're working a job or whatever, and you check it once a day, you might want to check it a little more often if you can, because things are going to move faster. And you can see that with the size of the candle that we got today, things are moving in at a much quicker pace. So there's always a better opportunity if you're able to kind of check things out a little bit more. Yeah, I will. We're getting to that right away here, Feng Mail. I'm going to show you guys some things here that like I said, I got a little paper portfolio here. I'll show you a couple of things that I did, and it'll hopefully help show you guys kind of what you can do with your positions to batten down the hatches, if you will. Okay. So, like I said, the last thing is just incorporate. Somehow I keep hitting that caps button there. Sorry about that. Incorporate more focus on the portfolio. Okay. All right. Let's get to our practice portfolio here. So hopefully this pops up for you guys. So like I said, this is just a little practice account that I've got some stuff in here. I added some things today that we're going to talk about, and I'll show you guys really what it means and how you can, like, actual examples of how you can kind of batten down the hatches, so to speak. Okay. So, yep, hopefully, all right, you guys should be able to see this portfolio shortly here. So with this here, you can see that I got a bunch of different trades on here. I got a fair bit of long stock in here. Got a few option positions. You can see that I've got some futures positions in here as well. We'll talk a little bit about that. The thing that I want to show you first and foremost is the delta number here. Okay, so let's see if I can get my pen working today to help you guys out. Medium. Let's go with the white. All right. So this isn't going to work that well for me because this thing is turned wrong. So bear with me. There we go. There we go. All right. I want you guys to see this here. If I can actually do this here. Bear with me one second. right there. I see that delta number there, 5,327. That's my delta number. All right. So what that means is that's a positive 5,327. What that means is if the market goes up $1, okay, then I'm going to make, you know, I should say that that's only if I beta weight that, but if the market goes up, this is what I expect to make if it goes up $1. Okay. Now, of course, that's individual stocks. You know, they're not all going to go up the same, but basically with this delta, I have a very positive or a very bullish delta. And the reason why is because if you look at this here, I've got 1,000 shares of Macy's, okay? I got 1,500 shares of United States Steel, 500 shares of BP. So I got a lot of shares here. Well, each share has a delta 1. Okay, so that's great that I'm all bullish and stuff like that. But the problem is if things get ugly in the market, which they did the preceding 2 weeks before the election, and they very well could have during today. You know, this is again the thing we don't know. This is where we got to kind of take things and trim them down so that we don't get ourselves into peril here. So a few of the things that I did here today, I'll show you just a couple of things. Again, you know, I looking at the market, obviously, you know, we looked at it earlier. It looks like it's poised to pop up there. Now, I do want to make a comment here. You can see that we've got a lower high here, and now we've got a higher low pivot here. So we're kind of in this consolidating triangle here. So the market's going to break out one way or the other. We don't really know which way it's not giving us the best indication of which way it's going to go, but it is going to go one way or the other soon enough. But with this kind of uncertainty, you know, who knew, like, you know, other than the fact that we already saw this go up a couple of days. Sorry, this is XLK. Looks a lot like the futures. It's exactly the same chart as you can see. You know, sure, we saw this go up the last few days and you know, maybe you thought, okay, well, it just keeps going. But the reality is, and I think this is poignant, is look where this thing basically ended, okay? It hit resistance and now it's kind of failing. So, you know, do we know that it's not going to turn back down here or going to explode up to the upside? We don't know. And this uncertainty is what we're trying to protect against. So, like I said, a couple of things that I did here today, just to kind of, you know, try and basically reduce some of the delta that we had. So, you know, Gilead here basically bought 3 put options. Okay, so bought 3 put options. If you look at Gilead Sciences here, they're in a heck of a downtrend here, right? Kind of getting beat up. Nice bear retracement here. So this is something where I was able to look and add a bearish trade to get rid of some of my delta, to offset some of my portfolio delta, and I was able to do it by putting on a bearish trade. Okay, so not only does that give me, you know, an opportunity to profit in Gilead, but it also, like I said, pulls away some of this delta that I got. Okay, so there was that. Now, one of the things that I did here was basically, let me get rid of that circle there. That's probably bugging everybody. So this here is, I colored United States Steel. So let's look at the chart of United States Steel. Okay. United States Steel today, as a few of the industrials did, it got trounced today. Okay. Broke the 9 EMA, broke the 20 EMA, and closed below that. Okay, even though they had, I think they had better earnings recently than they expected. They lost less money. Again, came up, hit some resistance up here, and then had a pretty bad day today. Well, if you're holding a position, especially the one I have in this account where you're sitting here with 1,500 shares, I don't think you want to sit through a drop all the way back to the next support level, which maybe 850. If it gets by that, you're probably talking 8 anyway. Okay, do you really want to sit through that? So what I did there was basically collared this trade. Okay, put on a covered call. You know, I had to go out 30 days to get the credit that I wanted, but put on a covered call, you know, at 48 cents, and then turn around and bought some puts, some shorter term puts there for 47 cents. So if we look at this from an analyzed perspective, okay, now you can see that I've got a profit on here. I'm going to take these things off. show all of them here. Okay, I'm going to take the hedge off. Okay, so right now we're sitting at what's the actual price here? Price right now. Why can't I see that price? Let's close that. So 909. So the price is 909 right now, which is right about there. Okay. So right now I'm sitting at a positive $5,000 right there. Okay. So I'm in a profit position. Well, I don't want to sit there and wait till it gets down to 8, because then I just give up $1,700. Okay. So what I did instead was I added on the covered call, which caps my upside. Okay, I'm willing to take that upside cap at 6,200 bucks profit. Okay, went spent a little bit of money on some puts to get through the uncertainty. Now puts are only good out to November 20th. So if it continues to be volatile beyond that due to the election fears or whatever the case may be, then I may have to reevaluate the trade. But right now, just trying to get through this initial phase. And as you can see, you cap the upside, but you cap the downside. So I cap the downside here. The worst case scenario, if it landed right on 9, is I'd be down to about $4,600 in profit on this trade. Okay, and if it really goes down, if it crashes, I still get the 4,900, and on the top side, you're still looking at some money here. So, basically, I neutralized that trade there. If we look at the delta, okay, let's look at the deltas here. Okay, so this delta is still a little high here. Looks like I should have done a little bit more. So with the stock here, you can see that there's a 1,500 delta. Okay, so when I throw the covered call on, I get it down to 833. And I throw the puts on, I get it down to 184. So what this means is if it falls, if United States Steel falls $1, I lose 184 bucks on this. Okay, that's a lot better than losing 1,500 bucks for every dollar this thing comes down. That's delta hedging an individual position. Okay, that's collar, and I know I saw some of you putting in some collar trades there. That's a good thing. Like I said, what you're doing here, and this, I happen to be in a profit position, which is nice on this trade. Maybe you're not in a profit position, but maybe you're trying to offset some losses. That's fine too. Collar trades work really well for that as well. Okay. So that's one of the things that we put together today. I've got a SPY credit spread on today. This thing here, it actually looking ugly right off the top here, down about 135 bucks, because when I put this on, this thing was quite a bit higher than this. So this is pulled back. But if this were something that was concerning me, okay, I might want to go and I might want to close, 2 or 3 of these contracts, right? If I really was concerned about this, I've got a $5 wide spread here, and I've got 5 contracts. So I got $2,500 worth of risk, and basically I only got about, what did this net me? Let's look at the SPY here. I get rid of some of this stuff here. Get rid of that, get rid of that. So this netted, I'll just get $1 something, $1.13. So $1.13, so $5 risk. Okay, got a legit risk here of $1,935 to make $565 here. That's not a great risk reward unless you're prepared to if you're prepared to drop that or at least do something to offset this. So like I said, in this case, I could get rid of 3 of these and drop this risk down from 1,900 to probably 1,200, or maybe even a little less than that. Okay, so this is what I'm talking about. When you batten down the hatches, you can get rid of those types of things. Now, let's say we had some indication, and in this chart I don't have that indication. Okay, but if I had an indication that this thing was going to get ugly, okay, let's say it puts in a doji tomorrow and it starts to fall, or maybe a big red candle tomorrow. Okay, that's when closing half of this, right? Maybe just closing the short legs here, maybe even just closing a couple of them and turning them into a ratio spread. So let me add a simulated trade on here. I'll assume that I'm going to close. That was November 13th. So I'm going to buy back 2 of my short strikes there. The short strikes were, I think, 325. Let me make sure I'm right there. 340. So I'm going to buy back 2 of these. You see here, let's buy 3 of them back. Okay, so if I was convinced that this was going to fall to the bottom, okay, all of a sudden, let me show you this trade again so you guys can see it. All right, so right now I got a $1,935 risk. If this thing starts to fall and I make a change to this trade, make an adjustment, now all of a sudden it can go anywhere it wants and I start to make some money. Okay, now it's going to cost me some money to close that out, right? I'm going to take a hit on that because I'm going to pay 482 and I didn't get 482 to when I bought it or when I sold it, I only got 398. So I'm going to lose a buck something per share. Okay, so it is going to cost some money to do that. But as you can see by the risk graph, if this thing starts to flag, all of a sudden you start to recoup some of that loss. Okay. So there's a couple of ways that you can offset some damage to your portfolio. Okay, like I said, talked about Guild to get some. And so now basically what I did here was, you guys can probably see that I've got some micro futures here. Okay, before that's in there, but I'm going to show you the beta weighting part of this. So as it stands right now, this portfolio is not beta weighted. Okay, it's not compared to anything right now, and this is just straight up delta as per the positions. Okay, so like I said, you know, if you think about this from a delta standpoint, if the market goes up or if these positions go up $1, then I could make $5,300. If it goes down $1, I could lose $5,300. That's excessive. Okay, most people aren't going to handle those swings very well. Okay, now what I can do is I click this beta weighting here and I can beta weight it to whatever index closely resembles the majority of these positions. Okay, so let's say they're in the SPY. They're not all in the SPY, but let's say they are. Okay, so I could beta weight this to the SPY, and then you'll see that these contracts, what I did was I sold 11 of the micro futures contracts here to offset the delta. So just by doing this, we go from a 5,300 delta down to a negative 63. Okay, so just adding those futures contracts, selling those futures contracts, and these are the micros, not the full ones. These are the micros, the little ones. Okay, we add a negative delta of 552. Now I could actually even do this. I could beta weight this to the micros themselves. Okay, and then you can see that my delta is down to 6.31. So it depends on what you're using to hedge it. And as you can see, I use, instead of using the spider, which would have cost a lot of money to do that, I actually use the MES here to offset some of this delta. Okay. So that's your beta weighting. What I'm trying to do now, like I said, this is a little bit over hedged here. Okay, I could actually get rid of one of these contracts right now. I could get rid of one of these, and that would bring this down by a delta of 5. Okay, so a full mini futures contract has a delta of 50. If you sell it, it's negative 50. If you buy it, it's positive 50. Okay, so we can add or take away delta as necessary. But if this gets down to 6.25, like I said, if all these positions change, or if the MES changes by $1, if it goes up $1, I lose $6. If it goes down $1, I gain $6. Well, most people, I think, can handle a move of $6 on their portfolio. Most people, I would say, can't handle a move of $5,300 if it's going against them. If it's going for them, right on, rock and roll. But this is why this becomes so important to delta hedge and reduce your risk. Okay, this is where it's going to save you a lot of heartache. Now, like I said, if I didn't have this one in here, you would see that this would still be a very big delta. Okay, but I just wanted to show you guys kind of how you offset some of the damage here. And again, the reason I have to go so many contracts here of the futures is because there's so much stock in here. Okay, this is a a portfolio that has a lot of stock in here. So what I was talking about before was core positions. Okay, so maybe U.S. Steel in this particular case is a core position. Well, you can see that hedging it by collaring the trade turns out to be a pretty good deal. okay? So even if I take the beta weighting off, okay, I got this US steel down to 189, okay? So it's not perfectly hedged, but it's down to 189 from 1500, okay? That's a really good way to just chill things out for a little while, okay? And, you know, we're actually taking in a credit, you know, as long as it stays under 9.5 between now and the 4th of December, you know, this protection, half of this protection will expire on November 20th, but you can see that we actually took in a credit to do this here. Okay, and so that's where it can be a really good opportunity to collar a trade and save yourself that pain. Okay. So again, you know, kind of just like I said, kind of looking at things here, you know, if you've got these core positions, I think this is probably one of the things that I find a lot of traders miss. When you've got these core positions, there's no real reason to ride through these types of events and kind of take it on the chin. You know what I mean? You can get in there and you can make some changes. You know, you can beta weight. Beta weighting's not that hard if you've got your portfolio all built up in here. Even if you don't, if you happen to be using Interactive Brokers or another brokerage and you've got a paper trading account for Thinkorswim, you can recreate your entire portfolio in here and you can see, okay, what do I need to see in here to make sure that I'm getting the right you know, the right offset, the right hedge. Okay. So, like I said, use these tools to your advantage and think about these things before these events happen. Like I said, it just so happened that things went down, you know, the 2 weeks beforehand, and instead of, you know, during the event. But, you know, we had no way of knowing what that event was going to bring. And frankly, even though the VIX took a big hit today, we're still at what are we at? A 29. We're at a 30 VIX. Okay, so for any of you that trading, you know, any length of time, really, you know, we were used to a 10 VIX, right? So we're 3x right now what we were used to for years and years and years. Okay, so there's still lots of volatility, even though this thing has pulled down. Okay, so like I said, we want to make sure that we're protecting ourselves in the best way we can. So any questions, comments? Let's see if I missed any there. So Colin says, can you talk about when you would remove the hedge? Yeah, so that's a good question, Colin. So if I were going to remove the hedge on this, obviously I would want to see some upward movement. Now I just added this hedge. I added this hedge here today, actually, just because I wanted to be able to show you guys that tonight. But the reality is you're gonna go to the charts, right? So let's go back to the S&P 500 futures. Okay, ideally, to hedge this, I want to be hedging this when support is broken. Okay, so you know we had a pretty good run here. You know, basically from September until, you know, middle of October, basically. And then we broke this trend line support here. You could have started to hedge here, okay? You know, you've got some crossovers here. So there's lots of little indicators that we can use to decide when to do things. You know, you could have looked at this and went, okay, well, it broke this lower trend line, started to go sideways. Well, maybe we don't hedge there. But when we see these moving averages, I don't know if you use moving averages on your charts, but if you see these moving averages start to cross over, so the shorter term, which in this case is the 9 and the 20, starts to cross over the 50, that is a line in the sand where things are getting more bearish. Okay, so if you saw that happening, you could have probably hedged here. Now, the question is when do you take the hedge off? Great question. Okay, usually when I see a reversal candle and a confirmation candle, then I usually take off the hedge the next day. Okay, so you know, you basically, there's part art and there's part science to putting these things on and taking these things off. Okay, but the reality is you got to let the chart do the talking for you. And the reality is, the way I look at these things is I'm always looking at support and resistance. I'm looking at I love the crossovers, even if you're late to the party. Okay, you know, like maybe you saw this candle here and you started to do a little hedging. Okay, you might not hedge fully at that point in time, which is fine, right? But maybe you started to do a little hedging there. Then when you got the crossover, maybe you hedged a little bit more here. okay? And so, like I said, if you're seeing this kind of thing happening, and this is easy for me to say because I've already got the candles here, but what I'm looking for, like I said, is I'm looking for some signs of life. And this is what we call a reversal candle here, this hammer candle. Then this is the confirmation candle. I don't do anything on these 2 days. But this next candle, if it's higher than the top of this candle, which in this case would have been the high of that day, and that price gets above there, that's when I'm taking my hedge off, okay? Taking the hedge off there and letting it work, okay? So now when would I put it back on again? Well, okay, maybe this turns out to be a doji tomorrow and then reverses to the downside again. Then we can start talking about putting another hedge, okay? So Med says, we still don't know what's going to happen. Yeah, you're right, we don't. We don't know what's going to happen. And that's the thing about doing hedging in general, is it's kind of a process where, like I said, it's part art and part science. It's not going to be perfect every time, but it's better to, the way to look at this is, even if it costs you a little bit of money, start thinking of this as insurance. Okay. So, this thing took a pretty big dip here back in August. Okay. So maybe you didn't do anything here, here, and here, but you got a crossover there. Okay. You got the 9 crossing over the 20. Maybe you put on some hedging there and you put on some more hedging there. That dip there. So basically from 32.90, got all the way down to 3,200. That's a 90-point drop. You're probably pretty happy you hedged there. Then you've got that reversal candle confirmation. You could have closed the hedge there. Okay. So you basically got to choose whatever works for you as a system. You can use moving averages. You can use Bollinger Bands. You can use price action, support and resistance. I like to use all that stuff. I look at support and resistance first, and then I start to add a couple of indicators on top of that. So that's kind of the way that I like to look at those things. So Mama says, I don't feel comfy trading until the stimulus news. What are your thoughts on it? Okay, great question. So yeah, so we got an FOMC meeting. Was that today or tomorrow? I think that might be tomorrow. So with that there, like, I know the government's got to do their thing. I'd like to hear what they have to say first, what the Fed's going to do. Yeah, it's I don't blame you, Ahmed, for staying out of the game. Like, this is what we were talking about tonight. If you're not comfortable trading, you shouldn't be in the game. That's the beauty of this. That's the beauty of being a retail trader. We don't have to participate if we don't want. So until you get that news, it's fine. Like I said, I gave you a whole bunch of different things that you could do. You could reduce positions. You could get out of position. You could do all of these things. You could just sit on the sidelines, because cash is a position. And I think a lot of people forget about that cash is a position. Okay. So there's nothing wrong with that. Personally, I'm always in the markets in one form or another. And for me, I think hedging is better because it still allows you to profit from the markets. But if you're uncomfortable and you don't have the skill level to do that, then sitting in cash is there's nothing wrong with that. Because like I said, we got 220 trading days a year. There's lots of opportunity to make money in the markets. You gotta feel comfortable, and you gotta be able to get into a rhythm. And if there's something disrupting that, then I would say definitely sit on the sidelines. Nothing wrong with that. All right, everybody. That looks like pretty much up my time there. I appreciate everybody coming out for the YouTube live here. This was a ton of fun for me. I hope it was for you guys. Enjoyed the questions and all the comments. And make sure you hit the subscribe and like button there. And